John Hancock Chief Investment Strategist, Emily Roland. All right, Emily, let's bring up the same table here because it all boils down, right? Duration, if it lasts long enough to trigger a recession, if that happens, then certainly the market would go much lower. But it sounds to me that you think maybe resolution is going to happen and the stock market will sniff that out before.
Exactly. If you look historically, Charles, stocks usually bottom before there is an ultimate resolution to these conflicts, and traders have almost been trained to act that way. We think all the time historically about panic sellers. Right now, we're looking at panic buyers in the market.
Right.
And so we've seen this support that's played a big role in sort of keeping markets.
We kind of learned that lesson last year. And
yeah.
it's not the retail investors, I think, that learned the lesson last year because they've been buying dips since 2020.
Yeah.
I think it was Wall Street. Everyone went down in April, May last year. Every firm took their target down significantly. Then later on in the year, had to take their targets back up. And I think everyone's reluctant to have the egg on their face to that same degree.
Absolutely. It was such a great buying opportunity. The last couple of corrections we've seen that have been meaningful have been very short. I'm talking 4 weeks during COVID, 4 or 5 weeks in the height of Liberation Day. So we have been conditioned to buy on these dips.
One area I want to ask real quick, with the private credit stuff, right? So Blue Owl Credit, you can see the redemption request. That little blue line is just how much they've met, folks. And this obviously is what's scaring the hell out of people. 41% request and only 5% met. So here's the thing. There's a great chart Apollo put out yesterday, and I want to share it with the audience again. I didn't really have a chance to talk about it yesterday. They're saying if you compare this to the housing implosion, collateralized debt obligations, the contagion, 60% exposure there, only 3% of U.S. households exposed here. Should we feel insulated in your mind?
Well, at the end of the day, the fundamentals aren't that bad. We look at things like high yield bond spreads as our measure of how much risk is being priced into private credit. We're still around 3% right now. Software companies produced over 30% earnings growth last quarter. Remember, this all started with the AI is going to destroy every software company's business, which we think is a little bit of a stretch here. So we're looking at really this being about the news flow. A lot of investors moved into these illiquid parts of the market, and they haven't had a full cycle to be tested yet. The test isn't going great right now, but underneath the surface, the fundamentals are fine.
And your note, you mentioned quality, and it was interesting to me because intuitively, market gets shaky. Where do you go? I want to own quality stocks. We don't know what it means, but it sounds perfect. This is about 30 minutes ago, right? So this is all red, by the way, folks, at the start of trading. We're starting to get some green spots as the session goes on. We love that. But this is the worst performer, large cap quality. How can that be, and what does it mean?
Markets are acting like the United States is the only part of the world that could be impacted by this conflict over in Iran. And you guys were just talking about this with Phil. You know, this is a global phenomenon, and it is amazing on a relative basis how well Europe is holding up. Japan's in the green this year. These are major oil importers that have a much bigger problem than we have in the United States. Of course, we're a net oil exporter. So we're seeing it get hit in the United States. High quality company, large caps, taking a breather after exceptional returns over the last few years. We think there's an opportunity to lean in now that the valuations have reset.
I know you also like mid and small cap stocks, right? So here's the coming into this week, S&P mid caps, small caps. And what really is amazing to me is like, this is a different picture than, for instance, information technology's up. They're 8.2% with mid caps. They're up with small caps. The whole balance, this is not what we see when we look at the S&P 500. You've liked these areas, particularly mid-caps.
Yeah, mid-caps have really been the sweet spot for us. And what you're going to get is a very different sector composition. You're going to get a lot of exposure to industrials in the mid-cap space. You're going to get some mid-cap banks that are benefiting from M&A activity. The industrials continue to be one of our best ideas here. It's the onshoring activity. It's the manufacturing renaissance in the U.S. It's all the picks and shovels around the AI and data center build out in the United States.
And again, you know, so for the mid caps, you got energy, obviously, but technology, consumer staples, a little bit defensive. But to your point, industrials there. Industrials also very nicely. I'm going to ask you about utilities. I'm going to pull up the XLU. Let's go here. A wonderful chart. They kind of got a two for these days, right? Back in the day, this is where you went as a safe haven. Now it's offensive and defensive with all of the AI spending, right?
Yeah, absolutely. And they've got great earnings growth prospects, less sensitivity to the potential for higher oil prices to hurt demand. They have great pricing power, and they also are benefiting from limited supply as it relates to power demand in the wake of the AI revolution. So we've been overweight utilities for some time. Infrastructure related businesses, another favorite area, ways to get more defensive but still benefit from growth.
Yeah, no, I know you. I know every time you come on the show, you talked about it, killing it. Thanks a lot, Emily. Appreciate it. All right, folks.